Pumpkin, pumpkin, look at me. Look at me right now, please. Straighten your back and get your mittens ready. Houses are the economy. You'll often hear this in traditional finance media. Do we need this to make money? Not really. Crypto, we hope and pray that it's disconnected enough such that people front run the future and we pump so hard so that when there are jitters in the housing economy, that we make a higher low each time. And the beautiful thing is, if you look back in history, that's true. You don't need to know this. But if you're intellectually curious, I will inform you of some secret orange juice. That's right. From the back of the fridge, the bottom left-hand side. So houses are the economy. It's really important. And it's by design. All right? It's by design. So look at this. Home sales directly lead to S&P 500 company earnings. Very juicy information to know this, okay? We'll go on. When home sales rise, the market cap of retailer homes go up in your street and people feel more confident to spend dollars. So you feel more confident. It's called the psychological wealth effect. So that's why market cap, it's just a product of our imagination. That's where it comes from, okay? If there are 10 houses on a street and your house, you bought it for 500,000 and then you sell it for $1 million, everybody in the street is going to say, wow, look at him. He sold it for $1 million. So they will reprice their own homes in their mind to about $1 million. And now the market cap of your street is $10 million. And let's say someone in your street, let's say they have a Bybit leverage trading problem. They lost a lot of money. They bet their grandfather's fluffy socks that was handed down through the generations. Now he's got nothing. And he has to be kicked out of the home. And let's say he has to sell his house for $500,000 again. Everybody in the street, they will say, oh my God, who was that noob who printed a lower house price? It was $1 million print. Now he's printed a $500,000 price. Now the market cap of the street's $5 million. And people feel bad. You're like, we lost so much money. You didn't really lose anything. It's just the market cap. It's the price quote. So that's why it's all about manipulation and grooming. Have you ever had a doggy sit in your lap and you just pat it? And he looks into you in your eyes, cute puppy dog eyes, and you just pat him? Well, that's exactly what the government wants to do to us. They just want to pat and groom us all the time. They don't want you to go, ruff, 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 ruff. As soon as you start barking, that's it. The emergency tools come out. So housing trickles everything down. When people get higher price quotes, and I'm not making this up, by the way. They've done so many studies on this. The Fed has done this. When people get higher price quotes for their homes, this is the number one most powerful effect on the economy and on the way down. Number two is the stock market, because the stocks represent about, roughly superannuation, 401k retirement for the average person. But isn't it interesting to know that houses overpower it? Houses are actually number one. Stonks, they're number two. So houses are the priority. Everyone can relate to it. So, think about this, right? I'm here as a messenger to show you friendship, eternal friendship, left, right, up, down. Think about in crypto, when someone makes like a super complex protocol, they don't relate to anybody. The average man, woman, child, and pet duck named Greg, you don't relate to this like mathematics, Greek letters, high-level university statistics stuff. You relate to the simple things. Well, it's just like the economy with houses. Everybody can see the house. The most basic person knows, this home sits on 500 square meters and another one sits on 700 square meters. Very basic comparisons. Bigger is better. And you know what I'm talking about. And we also know the difference between farmland and cities. It's so simple. So simple. That's why When house prices go up as a quote, it makes people open up their wallet more. And when that goes down through the interest rates, people slow down. It's an undertone, okay? So it funnels into S&P 500 earnings. You don't want to go get that new phone. Your socks, they're fluffy enough from last year. Your mittens, yeah, red's cool. You don't need to get green. That's what happens. And look what's happening on this chart. Because of the interest rate spikes, look what's happening down here. You can see home sales going down. So houses, they take a while to move. They're very slow. That's why, if we look on the bottom left here, houses, when they go up, like they are, there's this period where house prices, on average, they slow down sideways. And that's because the buyers and the sellers don't get much volume. You know why? The buyers and sellers, they can't find the price equilibrium. Because the people who live in the homes, right? So the people who, home owners, so want to draw a little house, they are in la la land. They go like, oh, my house is totally worth $4 million for this shoebox out by the beach. That's how they're thinking. They can't get with the times because all they've seen it do is go up. They don't know that houses have been in a bubble for like 80 years, right? They don't know that. They don't know any of this. They've just seen it go up. So now they're used to it going up. So now it slows down. And it takes about a year for them to come to reality and be like, oh, crap, actually, I'm not worth that much. You know why? Because eventually some people get desperate and some people start selling their homes and they just be like, screw it, I'll just take a like 5% hit. And then that trickles down. And then after about a year's passed, then the damage starts. That's when everyone's like, whoa, what happened to houses? Stand up, sit down. So, houses move very slow. Now, you can see another chart for you. As the Fed raises rates, home prices, right, they start dropping. The home sales. And I've written here, but it takes time. See, it always takes time with property. Because people are in la la land. People are very slow in property. They are not market people. They are not addicted to illicit substances like we are in crypto, right? I'm here 18 hours a day giving you free content. I love you. You love me. We are friendship. 4 hearts of friendship and justice. Like, subscribe, bell button, all please. And people in property, they're less cracky, if you know what I mean. So after about a year, that's how long it takes for people to realize, oh, there's been a change here, right? Because they're so slow. All they can think about is like last year or next year. Okay? In crypto, we're like, oh my God, what happened 4 hours ago? There's a red candle. That's how we think, okay? And unfortunately, retail, they stay in denial for longer. All right? But we're in a pickle. And I'm going to draw a pickle for you right now. We are in this pickle, okay? This pickle is going to be smiley and is going to have some wrinkles, okay? So we're in a pickle. If the US, we're going to read this part together. If the US Treasury bonds crash, they're going to do yield curve control. And I've made many posts on this. You never know, by the time you see this video, maybe they have crashed. I don't know. They have to do yield curve control. But they're not going to cut interest rates to rescue retailer homes, okay? I'm going to make a video on this again in the future. But QE simply, all right, this is a chart, all right, of bonds, okay? QE is when they actually market buy bonds. They just market buy them like every month, right? They actually hit market. It's like you go to Uniswap and then Tether prints you money and Tether says to you, hey, go buy $100 million of Poor Pleb every month. And you're like, yes, sir, 100 million PP at your service. You market buy it. You hit market every month. That forces the prices up. That's what they do for bonds. But that's QE, friends. That's QE, okay? QE. Quantitative easing, all right? That's when they market buy. But yield curve control is not this, friends. Yield curve control, so YCC is, what's happening is, this is the bond price. It starts sinking too low. All right. And yield curve control is what they do is they provide a bid. All right. They say, hey, if the price drops anywhere below here, we're going to put an infinite bid. Infinite bid. It's like Tether approaches you and says, hey, my PP is at 1,000 units. If my PP drops to 300 units, I want you to buy it up to 400. And then you say, yes, sir. What if it drops again to 300 after that? You go, you buy it again. And they say, okay, what about if it drops again and again and again, infinite? And that's what they do. That's literally what they do. They have the printer. They keep printing infinite money. That's what yield curve control is. But in this yield curve control example, they don't push up the price by hitting market. They want it to like calm down, but they don't actually make it go to the moon. That's the QE part. They don't hit market. They just prevent it from going to extreme prices. See, with the bonds, because this is a bond price, right? If the bond price actually gets down here, the treasury means the rate it's giving, like retailers, your mortgage is not like 7% anymore, your variable rate. It goes to like 10, 11, 12%. It'll crush everyone. But yield curve control means they're like, hey, 11 to 12% is too much. We're going to put everyone in the Great Depression again. So let's stop it at like 8%. That's it. It can't go higher than 8. But because they're stopping it at 8 does not mean the market will go trade back at 2% for your borrowing. You're still caught between a rock and a hard sock. Unfortunately, the Fed wants to crash house prices further. I don't like bringing you this Grim Reaper talk, but that's what they want to do. They know the number one psychological wealth effect is house prices. They put rates up, they target the house prices, they have a word with the lenders, they go, look man, you're going to have to start squeezing people by the balls, and if they're women, you're going to have to squeeze them by the ovaries. And they do that, and I'm sorry, but it's very sad. This is just how the system works. I hope we do really well in crypto for you to retire and put yourself ahead for your future of your family. Maybe you've got a pet duck named Greg as well. Please think very hard about joining the property game. All right, because you are forced to take on leverage. They do not let property go to fair value. They don't let it go down to crypto prices. You see Bitcoin here? There was nobody rescuing Bitcoin in the first parts of its lifetime, okay? You see here, look at this part here. 92% down, 86% down, 82% down. These are free markets, right? These are free. This is the market reaching, and even here, reaching a fair market price on the way down. They don't let this happen in property because it's the Great Depression every literally 30 years. People get too excited. You know you get too excited, man. So, think about joining the game. You don't have to play that game. You've got an asymmetric risk-reward opportunity here with crypto. You can start with Bitcoin, tickle your fancy with Ethereum, go down to my favorite altcoins. That's completely up to you. I'm just pointing you in the right direction. No one likes this game, so you should come play it. Less competitors. All right. But that's what the Fed wants to do. They want to crash house prices. They want to reset it. Jerome Powell, the Fed Reserve Chairman, he literally said in a speech in 2022, he said, for young people, house prices are too high for you guys. You're going to need a bit of a reset. That's him walking on eggshells. He admitted it. He told people to their face, you need a reset. You know what a reset means? Minus 20% and stay down and stay crushed. That's what it means. But the debt in the economy is too high. I don't know how long they can do this. See, when they do this for too long, there's too many zombie companies. You have carried the weak people on the bus. You should have left them at the station. But now we're on the bus with you. Instead of 30 healthy, young, strong footy members teams, you've got the weak fatties at the back. That's exactly what's happened with the economy. We're carrying the luggage at the back. And every time they bail everyone out, instead of one fatty, now there's 3. Now there's 5. Zombie company estimates, it used to be like 4%. It's up to like 20% now. I've shown Twitter posts of this as well. So think about your future going forward now. There will be a time and place to punt on property. Just like how in crypto, the time to buy is when everybody's depressed. I think the time to buy a house is when, that's right, when you actually see depression. Problem is, friends, I don't know if they'll give us depression in houses ever. Ever. I think they'll keep saving the system. But to save the system, they have to print money. And to print money, crypto is a higher sensitive growth asset when they do that. That's why it's very worth your time to sit here and admit, are we not friends? Are we not friends? Answer me that. We are friends. So here's the total crypto market cap. All right. I just want you to think to yourself, whether there is a depression, whether there's a boom, bust, I don't care, everything in between. This is total crypto without Bitcoin. It's only 570 billion. All right. I think one day we can hit 6 trillion. That's just me. All right. I don't know about you. That's just me. I think we solve way too many problems. You know, property is about 200 to 300 trillion in the world. Look at this. Non-Bitcoin, even if you include Bitcoin, we're only 1 trillion, man. That's tiny. They're 200 to 300 times bigger, right? So every $1,000 put into us has a multiplier effect of 300x compared to property. It's cheat code. So you have the answers now. Please, if it's cold where you are, wear a beanie. And if it's hot, drink some orange juice. I love you all, friends. Till next time.